Hey guys, welcome back to the channel. My name is Xuan Kai and I'm a day trader from Singapore. So today's video topic was actually inspired by a comment by Jess B, and it was to do a video based on how to pick option contracts like out the money, in the money or at the money. So I figured that since I'm trading with a relatively small account and a lot of people can relate to this, it would be helpful to you guys to show how I pick my option contracts to trade more effectively. So let's get into today's video. So as you can see here, what we have over here is the option chain for a think or swim platform. So over here you can see that I have Tesla set up already. So Tesla's current price is $713. So basically these are the option strike prices, not strike prices, the option strike dates for Tesla. So you can see that over here we have 13th of August 2021, which is the option premiums and option contracts that will be expiring this week. So I'm going to press on them and it's going to open all the strike prices for Tesla. So basically over on the left side we have the calls. You can see over here the calls, and over here we have puts. So for calls you have bid and ask, and for the puts you also have the bid and ask. Same for the stocks as well. So basically there are three things that need to be explained, which are out the money, at the money and in the money. So basically at the money just means the option premiums that are closest to the current price of Tesla. So Tesla is currently at $713, so the current price that's closest, you would be either the 715 or the 712.5, which is considered at the money for the call side, right? Same for the put side as well. At the money is kind of about the same. It just means the strike price that is closest to the current price of Tesla right now. So for calls wise, you can see in the money just means everything that is over here on the blue side. You see over here, you can see a sort of everything here is black and everything here is blue. So everything within the blue section is considered in the money, and everything in the black section is considered out of the money. That's the more layman way of seeing it. So it's a little bit more straightforward in that sense. So you can see that for this as well, let's say for 715, strike price of 715 over here, we see the bid is 1015 and the ask is 1025. So which means each contract will cost you between $10.15 to $10.25. So if you put that into sort of one contract wise, it's going to cost you $1,015 to $1,025, which is somewhere around that range for the at the money contract for Tesla wise right now. So you can see as you go further in the money, you can see that the prices become a little bit more expensive, all the way to $3,000, $5,000 also have. And then as you go out of the money, you can see that it gets cheaper and cheaper to maybe just a few dollars and just a few cents. For the puts wise, you go it the other way around. So in the money is when the price gets more expensive. So at the money, you can see it's about $9 to $10, $11 as well. As you go sort of in the money, it becomes much more expensive. You have up to $3,000, $5,000, maybe even $10,000. And then if you go out of the money, you can go up to $600, $300, $200, $100. You get the gist of it. Basically, this is how you see out the money, at the money and in the money. So basically the options move quite differently depending on where they are. So usually I trade at the money, which is like I mentioned just now, the 715 or 712.5. I trade usually at the money or out of the money. So at the money usually moves a lot more, which will result in bigger wins or losses. However, you can see that they are a little bit more expensive compared to the out of the money as well, which move less but they are cheaper to trade, right? So logically, if you don't have a problem with your trading capital, your trading account is of a reasonable size, like for example maybe around 30,000, then it's a little bit more straightforward. You can just pick the option strike price that is at the money, right? So what you really want to look for in options is volume. You have over here volume and open interest, right? So volume just means how many contracts were transacted for that day itself. And open interest means that the total amount of outstanding contracts at the option price. So it means how many contracts have been bought and haven't been settled yet. So either the contracts haven't been closed by the sellers or the options have not been exercised yet. So basically you want to choose a combination. You want to choose an option price that is a good high enough volume and open interest. So what this guarantees is that at least there's liquidity and the spread will not be so bad. So liquidity is very important because if you cannot get filled properly on your entries and your exits, you will end up paying for it in slippage. And since options are very, very volatile, you might end up losing money even if your trade goes well in your favor because you did not choose the right option price. Yep, the right option strike price. So if the options strike price has good volume and open interest, you will see that the spreads are usually closer together. So you don't get filled at a bad price when you enter your trades. So a huge spread might mean that you are straight away down on your position at the moment of your entry, which makes it even harder for you to make money. So like we mentioned before, if you do have a bigger account, you can choose add the money for calls, right? And let's say you want to buy one contract for calls right now and Tesla's strike price. Tesla's price is $713.69. So like I mentioned before, at the money will be either 712.5 or 715. So which one do you pick? You actually go over to the volume and the open interest. So right now you can see, of course, the market is closed at the time of me recording this video. It's because the market is closed. That's why you don't see anything on the volume wise. So this is how you will see it right before the market opens. So this is a way that you can actually use to prepare your option strike prices that you want to go for. So you can see at the open interest wise, you want to choose either 712 or 715. Then you move over. Volume wise, you don't know which one is going to be traded more during the market open, but it's more or less correlated to the open interest. So this one only has 602 contracts, while this one has 3,329 contracts open. So I would pick the 715 at the money instead to trade. Yeah, so let's say just like me, you're only trading with a $4,000 account. Of course, as a day trader, I want to have maybe around 4 day trades a day, for example. So I have to divide my account by 4, which means the total capital I can put for each trade is just $1,000. So now I have to find an option premium that's worth $1,000 or less and have good liquidity. So let's search for one. Right, so if you look down here, I can't trade at the money because at the money is $1,015 to $1,025, which is more expensive than what I have in mind. Alright, so I have to go downwards. So basically look at the open interest. You can see 8.6k over here, which is pretty good. So 720 would be where I would put where I want to trade for the option strike price. If it was still too expensive for you, you can go further down. So you see maybe this one has 2,000, 4,000, 2,000, 3,000. So the 4,000 one should be pretty good. 730s, right? If this one is still not good enough, you can still move further down. 3.9k is not too bad for 740, but you see if you go a little bit lower, 28,000, 16,000, yeah. So these two are really good, 750 and 755. Of course, you'll probably pick the 28,000 one. So you can see that as it goes down in very, very nice numbers, around the 720s, 30s, 40s, 50s are all pretty good. And you can see even then, the two that I picked just now, between the 715s and the 712.5, you can see that this one has bigger, more volume, more open interest, and you can see the spread. So this one, you can see the spread is between $15 and $25. So the spread is just $10 over here. But over here, for the 712.5 strike price, you can see it's between $11.30 and $11.50. So the spread is 20 cents instead. Right, so this one the spread is only 10 cents, but this one the spread is 20 cents. So if you choose the one with a poorer open interest, usually you get a poorer spread and a poorer feel as well. Yeah, so of course you can't see the volume right now, but when the market is open, usually those with higher volume, higher open interest will have higher volume as well. It will correlate quite well actually. And as long as you pick quite a nice number, usually for Tesla wise, I'm more familiar because I've been trading Tesla for quite a while, but usually you see the 750s, 700s, the very nice numbers. Every 50, usually you get a very, very nice volume and open interest for that. Yeah. So same thing for the puts aside. For the put side, you see for at the money wise, either you pick 712.5 or 715. So which one will you pick for over here? You can probably pick the 715 because if you look over the open interest, one is 1,191 while the other one is 159 contracts only. So obviously you'll pick the 715 for at the money. If you want to do the example that we took before with the $4,000 account, you probably will go for the 710. Right, or maybe you can go a little bit lower 705 is not too bad, but look at this one, 20,000 over here for the 700 strike price. So you probably take the 700 strike price for the puts. Yeah, so if you've enjoyed this video so far and it's been helpful for you guys, I would really appreciate it if you guys can smash the like button and subscribe to my channel, and definitely hit that notification bell for further updates as well. Leave a comment down below and let me know if this video has helped you in any way. With that, let's get back into the video. So the option premiums for different stocks are also different. Let's look at stocks that are more expensive and stocks that are cheaper as well. So if you go to more expensive stocks like Amazon, for example, let's go over to the Amazon option chain. So Amazon is very, very different compared to Tesla. Even shares wise itself, Amazon itself is an expensive stock at $3,341. So even shares wise, it doesn't have a lot of volume. So same goes for its options contracts as well. They are more expensive and they do not have the same kind of volume you see in Tesla. You could see that Tesla has for the open interest, you have like $10,000 open interest. But for Amazon, even at the money itself, only 500. You see, it's a lot lower than Tesla, right? Yeah, because it's more expensive. The premiums are more expensive, so less people can afford to trade them. Hence, the volume and open interest is lower. And you can see that at the money for Amazon, it's only 583 for Amazon. Yeah. So of course, if your trading account is $4,000 like mine and you want to trade Amazon 4 times, there's no way that you'll be able to afford this. Look at this. How much is Amazon at the money? It's $2,630 to $2,830. The spread on this is insane. It's $200 spread on this, which is a lot of money when you trade more contracts as well. Yeah, so there's no way you'll be able to afford this. So you have to go back to the option chain and choose the right options premiums. So of course, if you want to choose at the money itself, would you choose 3340 or 3335? Look at the open interest. One is 196 and one is 583. So obviously you will trade the 3340. But like I mentioned before, the $4,000 account, you want to trade 4 times, so $1,000 per trade only. So you can't trade any of this because they are all too expensive. You got to move down, look at the open interest very nicely. Look at that, all very small numbers. Boom, 1,680 contracts right here. So probably the 3,400. So like I mentioned before, the very, very nice numbers. So 3,400, you can see that 3,450, even without looking at the open interest, I know probably it will be a very, very good number for open interest. So if I go down to 3,450, you can see right over here, the next one, that's 1,631. So these are all where the retail traders and institutional traders are at. You can see these are where they are at. So that's where you want to be trading. So the spread is actually smaller over here as well. So you can see 750 to 820. So the spread is only 70 cents. But if you go to something that is really, really bad, for example, let's say this 3385. So how much is the spread over here? This one over here is like $1.20 for the spread. So you can see if the liquidity is bad, you get a very, very bad feel. If you want to trade even cheaper, you can even go further out the money at 3,500 again, and you can see nice open interest at 2,130, and the spread is even tighter over here, only 8 cents. So you get a very, very good feel. You get a better feel compared to if you are trading a very, very bad contract with poor liquidity, poor volume, and poor open interest. So you can see how important the volume and open interest are at. Yeah, so then let's go to a cheaper stock like Apple. So if we move on to Apple, you can see Apple is only $146, right? It's $146. It's a lot cheaper than Amazon and Tesla. So the stock is cheaper. There's good volume in the stock itself, and the options. So even with a smaller account, you can still very comfortably trade Apple at the money. Yeah, so because they are so cheap, it doesn't make sense to go that far out the money like what I did with Amazon, because then the contracts will be too cheap and you'll be struggling to even cover your commissions. Look at the money. So it's $146. So at the money, you can say it's probably $146, right? Yeah, but then look at that, it's only $120 to $124 per contract. If you go out of the money, like what, $160, that's like what, 1 cent. $1. And if you go a little bit higher up, you see it's only $16 to $17, $27 to $8. You can comfortably afford at the money for Apple itself. Yeah, so it really doesn't make sense to go that far out the money. So one thing to note as well is that the different stock options move differently and they have different amounts of volatility. So that impacts how much you can possibly earn for each of them. So for example, Tesla is very volatile. So even if you trade out the money, Tesla moves a lot and the option premiums usually move a lot as well and can earn a good amount. However, if you were to trade Apple is a relatively smaller mover compared to Tesla. So if you trade out the money or even at the money, the gains could still be smaller. So over here, if you were to practice as well at the money for calls, would you be picking 147 or 146? Right, so 146 of course is closer, but of course the open interest for 147 will be higher, so probably you will see a much better volume it's as well on 147 instead of 146. However, because you can see there's so much more open interest over here. Look at this, 45,000, 17,000, 19,000, 25,000. These numbers are insane. You won't see them on Amazon or Tesla. However, since the open interest is already so high, it might not make such a big difference since they're all quite popular and widely traded as well. So see, the spread is all very, very thin. It's just 1 cent, 1 cent, 1 cent. That happens because it's very, very liquid. There's a lot of liquidity going on. Yeah, so the last thing I want to really emphasize will be that the day that you are trading the options for. So for example, right now we are trading the same week expiry options. So today is a Tuesday that I'm filming this video, so you'll see that the option premiums are a little bit more expensive. As it progresses further through the week, you'll notice that IV over here will decrease and the options, and so will the option strike prices. So if you go back to Tesla right now, Tesla wise, you can see Tesla wise right now at the money, you can see that it's $10.15 to $10 to $11. Let's just say $10 to $11. But as it moves closer to Thursdays or Fridays, you'll notice that the option premiums will probably decrease to about $4 to $5. As the week progresses, the option premiums get cheaper. However, you need to know that they get more volatile as well. So the same move that happens on Monday could possibly get you maybe around $100 on Monday. However, that same move on Friday could get you $200 or more because of the increase in volatility. Right? So this is my advice. Even though it is cheaper as you approach towards the end of the week, which means you can technically afford more contracts. Right now, I can only afford one contract of this at the money with my $1,000 per trade. So if it becomes like $5, then I can afford two contracts. So does that mean I'm trading with two contracts on Fridays? Personally, I don't think you should do that. So what happened to me is that it's actually a lot smarter, in my opinion, if you go a bit more out of the money as it progresses throughout the week, or you trade a little bit less contracts. So what happened to me a lot of the time is that I'm able to trade relatively alright for the first half of the week, but then I let the increase in volatility for the rest of the week wipe out my gains. So you don't really want just that one trade on Thursday or Friday where you screw up and then you give everything back and everything that you have earned for the week back and more, which doesn't make sense to me. You definitely have to sort of secure your gains, and for me, my advice would be either trade less contracts or definitely trade out of the money, further out of the money as you go towards the end of the week. Yeah, so then that's all I have for this video. As always, if you enjoyed this video, don't forget to smash the like button and subscribe to my channel. Leave a comment down below and let me think what you guys think about this video, and hopefully I'll see you guys in the next video. Bye bye.